Welcome to this virtual discussion. We're covering the International Monetary Fund's April 2020 Global Financial Stability Report. I'm Elizabeth Schulze. I'm a multimedia reporter at CNBC. Today we have two wonderful speakers as part of this discussion. Tobias Adrian, he's the financial counselor of the IMF, where he is the director of the Monetary and Capital Markets Department, and Fabio Natalucci, Deputy Director of the IMF's Monetary and Capital Markets Department. Thanks so much to both of you for this discussion today.
Thank you. Well, it's great to be here. Thank you.
So before we get into the latest research, let's start with an op-ed that was published yesterday in the Financial Times by the IMF Managing Director, talking specifically about banks, dividends, and buybacks, calling for banks to end all buybacks and dividends as we face the coronavirus economic crisis. What's behind this idea that banks should end this practice for shareholders, even as their kind of stocks are getting battered themselves right now?
We are still in the early days of this crisis. The macroeconomic news that is coming out is very adverse, and there is tremendous downside risk. In crises like this, we hope for the best, but we have to prepare for the worst. And preparing for the worst in terms of bank capital means that stopping payouts, either in the form of dividend payouts or repurchases, is going to help build capital in the banking system. For example, when you look at the 30 largest banks globally, the globally systemically important banks, those paid out about $250 billion last year. So that's a substantial amount. And by stopping the payouts, that's helping to build up additional cushions against further adverse shocks. If all goes well, this is capital that can be paid out in the future to shareholders. So it's not money that is lost somehow. It's just retained in the bank as protector, as buffer against any future adverse shocks.
And Tobias, what's the point at which regulators should start getting involved in this conversation and policymakers? You know, we have seen the Bank of England really encourage banks to take this step. Should all policymakers be encouraging similar action?
Yeah, there's a variety of approaches around the world. As you mentioned, in England, the Bank of England has strongly encouraged the banks to stop payouts, and that's what they have done. In other countries, such as Brazil, regulators have actually put regulations in place that stop payouts, while in other countries like the US, there's a process of conducting stress tests to determine whether banks should stop payouts.
So this topic is fitting in line with one of the recent chapters of the new Global Financial Stability Report, looking specifically at low rates, low profits, and bank profitability. So what's your outlook for bank profitability in the near term right now as we face this uncertainty from the coronavirus pandemic?
Economic activity continues to slow down around the world, and that means that profitability is going down. The question is, how much further does it decline, and how long is that going to last? And of course, the ultimate determinant of that is going to be progress on the medical front. Is there going to be some form of immunity? Is there going to be a vaccine? Are there going to be medications that are effective at an early stage? All of these are questions that have a lot of uncertainty around them. And that's going to determine how much longer the very drastic measures of lockdowns are going to be implemented in countries around the world. And then that determines how long and how deep this recession is going to last. And that in turn determines the profitability. So as an analyst, you have to think through many hoops in order to figure out what the baseline is. And there's a tremendous amount of uncertainty around any of these calculations at the moment.
The report also looks a little bit more into the future, despite that uncertainty, into the medium and longer term, suggesting these profitability pressures on the banks are going to continue through 2025. So talk a little bit about those findings and why that struggle will continue even as the economy, starts to recover.
So we have been in an environment of low interest rates and low inflation for some time. And when you look at yield curves in the marketplace or break evens, so this is market implied inflation expectation, those continue to be very low for many, many years into the future. So we can expect that yields are low and the slope of the yield curve is low. And of course, the slope of the yield curve is an important determinant for bank profitability. Our expectation is that there will be continued pressure on bank profitability for many years to come.
What can banks do to try to make money? You know, margins are already so squeezed with, as you mentioned, low rates, negative rates in some countries. Are there cost cuts that need to happen? Are there fee increases? What are some of the steps that you think need to happen?
So we have seen in some countries around the world where banks are more profitable, and that is typically done via cost cutting and bank restructuring. Those are the two key ingredients. And there will be a tremendous amount of pressure on banks around the world to continue down this road, cut costs and consolidate in order to be more efficient.
How can banks do that when they're already facing so much competition? We've spoken a lot in various discussions about the rise of fintech and the competition from newcomers in the banking space. So how can banks remain competitive, cost cut, and still be profitable?
Well, banks are very good at adapting. For hundreds of years, banks have faced new technologies, new entrants, and they have managed to reinvent themselves many, many times. And when I talk to bankers, they are very actively engaged in updating the way in which the business is done, in terms of serving customers better and in terms of taking advantage of new technologies. So yes, there are new entrants, but banks themselves are also big innovators.
And are there specific steps that policymakers need to be taking right now to make sure that banks are solvent throughout this crisis, that they're able to continue to provide credit in the near term and in the longer term as well?
The good thing in this situation is that we have been through a decade of regulatory reforms that have led to a much higher level of capital and liquidity on bank balance sheets than was the case in the previous crisis of 2008. So banks go into this crisis with a lot of capital and liquidity. Having said that, this is a very, very severe economic crisis. And that's why the managing director has called for retaining earnings on bank balance sheets to make them a little bit more resilient in case that there are further adverse shocks. We hope that all ends well, in which case banks can pay out those retained earnings in the future once the crisis is over.
We'll talk later about the financial markets and the broader economy, but first, let's get into the second chapter of the Global Financial Stability Report, looking specifically at credit markets and risky credit markets. So Fabio, I'll go to you here. What are the biggest vulnerabilities in credit markets right now?
Yeah, so we have seen risky credit markets. What we mean by risky credit markets here is the high yield bond market, leveraged loans, and private debt markets. Those markets have grown significantly over the last 10 years. We have seen that at the trough of the COVID-19 crisis, essentially this market came to a halt. Issuance stopped, spreads skyrocketed. There was essentially no market asset for some of these firms. Then in the second half of March, when the Fed announced some of the crisis era's facility, they were essentially trying to unclog the plumbing of the financial system, and where not possible, they bypassed essentially financial intermediaries to reach the end user, to essentially get the flow of credit going back again to firms and households. Then those market sentiment recovered and those markets start open up again. We have seen some issuance even in the high yield market now, and spreads have come down quite significantly. Now, the underlying fundamentals though have continued to deteriorate. We have seen default rates rising in the high yield bond market, a little bit less so in the leverage loan market, and we have seen migration ratings, so downgrades on the part of rating agencies. The vulnerabilities were already there before the crisis, and we have done a lot of work even before this Global Financial Stability Report looking at these vulnerabilities. Those includes weaker credit quality at the borrower level, so for example, high and rising leverage at the firm level, so the borrowers, we have seen weak underwriting standards and weakening of investor protection. We have highlighted liquidity risk at bond mutual funds, for example, and loan mutual funds. Then we also, the report tried to map out, so produce an ecosystem of these risky credit markets, highlighting the interconnectedness between the banking sector as well as what we call non-bank lender or non-bank financial intermediaries. Those have grown, as I said, quite a bit. They've become more interconnected, they've become more opaque and more complex. Now, the banks remain at the center of this market. They provide they lend directly to firms. They provide lines of credit. They also have direct and indirect exposure. So they lend to these non-bank lenders. They provided financial leverage. They provided sorts of financial services. But at the same time, the non-bank financial lenders, non-bank financial intermediaries have grown quite a bit. And the risk that we highlighted there, apart from interconnectedness, are liquidity risk, for example, and possible layering of leverage and liquidity risk that may play out in some nonlinearities that amplify the shock.
What are some examples of those non-bank lenders and how quickly they've grown in the past few years?
So they play an important role in leverage finance, where maybe half of the lending now comes from non-banks. Those include like collateralized loan obligation and the investor into the structure. So pension funds, insurance company, other asset manager, even hedge funds. They also include bond mutual funds, for example, in the high yield bond market. And again, pension fund, insurance companies, as well as what we call the private debt market. So middle market CLOs, BDCs, as well as the private debt sector. Now, the reason why we focus on these non-bank lenders is because if there is a shock and this sector becomes an amplifier of that shock, that could in some sense generate a recession that is either deeper than otherwise or more prolonged than otherwise. So we want to make sure that these vulnerabilities don't become a source of amplification of the shock.
Should policymakers consider regulating those non-bank lenders in the same way that they would already traditional banks?
So the big question here, to the extent that some of these entities has benefited from policy support now, the question is whether authorities should consider widening the regulatory perimeter to include at least some of these entities. I think it's important post-crisis to take a stock of what happened, what vulnerabilities have been unmasked by the crisis itself, and based on that, come up with a clear mapping of the ecosystem where the weaknesses are, and consider whether there's a need for a new framework in terms of macroprudential to address some of these vulnerabilities, to tackle some of these vulnerabilities, and ultimately whether new macroprudential tools are needed.
So Tobias, one of the biggest questions is how we prevent another financial crisis that was extended and prolonged, like we saw from 2007 to 2009, and how we make sure this COVID crisis doesn't become a longer financial crisis. What are some of the things that need to be done on that front as we face this unprecedented economic downturn?
Policymakers have acted aggressively to address the COVID-19 crisis. This includes monetary policy, fiscal policy, and regulatory policies. Central banks have eased monetary policy, have put into place programs to support markets, and have injected liquidity across institutions and across markets. On the fiscal front, programs in many countries in the world have been rolled out to help households and help corporations to weather this crisis. On the regulatory front, regulators have allowed banks and other financial institutions to use their capital and liquidity buffers to weather this crisis. These policy measures have been successful so far. However, there could be further downside risk to the economy and as a result to the financial system.
We have seen in recent months this disconnect between what's happening in financial markets, especially in the US. Stock markets have rebounded, really come off their lows, while the economic data has continued to be extraordinarily bad. And really, we've seen extraordinary weakness in the economy. Are you worried about that disconnect between those two parts of the economy and between financial markets?
Financial markets turned around when investors saw that policy measures were going to be large and broad. So fiscal policy measures, by our count, are above $8 trillion at this point. Asset purchases by central banks around the world have been above $4 trillion so far. this is just over 2 months. So these are very aggressive policy measures that are going to help the economy to weather the crisis. And markets have priced in this very supportive policies from around the world. Having said that, some sectors in some countries have seen very fast increases in asset prices. And of course, there is scope for further bad news on the economic front or on the medical front. So there's always a risk of a further downward adjustment in prices.
So that leads us to the third chapter of the Global Financial Stability Report then, that looks specifically at emerging markets and frontier markets. Tobias, what is your overall outlook for emerging markets right now?
Emerging markets have been hit by the virus, just like other countries around the world. When we look across countries, we see a differential impact in the virus, a differential impact of the adverse economic conditions, as well as in terms of financial conditions. And so the market is pricing in a very differentiated amount of risk across countries. Some countries are beginning to recover from the crisis, but of course there could be further setbacks down the road. Other countries are still in the run-up phase of the virus. So it really depends. In terms of the capital flows, there were rapid outflows earlier in the year, and now some of this capital has come back, but it has come back much more strongly to those countries with strong fundamentals.
Fabio, the new report looks specifically at flows in both equity and debt markets in emerging markets and frontier markets. What are some of the main drivers of what foreign investors are looking at when it comes to those different sectors?
So the outflows we have seen in terms of portfolio flows to emerging markets provide an important case study to highlight the importance of understanding the drivers of debt versus equity and the implication for financial stability. As Tobias mentioned, we have seen cumulatively up to $120 billion of outflows from emerging markets, both equity and debt. That's about more than 0.4% of emerging market GDP, so it's quite sizable. The outflows started primarily in equity and primarily in Asia. One can think of the reason being that's where the virus originated, and that's where the concern about economic growth were there. And then they also moved toward outflows started being evident also in that flows. We've seen an improvement in these flows, so the outflows have essentially flattened out. In fact, in some countries and master classes, we start seeing some modest inflows. It's a little bit like the investment grade in high yield bond market. We have seen an improvement, particularly for the higher rated countries. So for hard currency issuance, April was a very strong month for high rated countries. We have seen also issuance in the BBB, and the optimism is starting to trickle down also to the high yield market with some BB issuance and even lower. And that reflects also not just in quantity, but in pricing themselves. So the report highlights that both for debt flows as well as equity flows, global financial conditions are particularly important outside normal times. So both equity and debt are very sensitive to financial conditions in times of either high flows or very large outflows. In terms of domestic fundamentals, those play an important role for equities and for local currency debt. And what I mean here, domestic fundamental means the importance of having growth in place, the importance of having depth in financial markets, credibility of frameworks. Then the report looks also at the role of foreign investors in some of these markets, both equity as well as local currency debt. And it shows that obviously there are benefits from large inflows coming into these markets because it can help lower the cost of external debt. But there are also financial stability considerations to the extent that these markets are not, the debt of the financial sector, it's not, those markets are not very deep, to the extent that they are concerned about the credibility of the policy framework, of the institutional framework. That could become a major amplifier in terms of volatility of yields during times of stress.
And you also looked at these frontier markets, which have been favorable among some investors who are looking for yield. You know, they've been able to deliver, especially in this low rate environment. So could those frontier markets actually become more attractive in this low rate environment that's looking like it'll be around for a while here?
So these markets essentially have been shut down in terms of market access. So frontier markets have seen spreads skyrocketing. Some countries north of 2,000 basis points, and access, market access, essentially is not there now. The expectation is that with global financial condition easing and with market sentiment improving, again, as we won't go and improve from the higher rate to the lower rate, essentially may gain access to markets again. But at this point, the market access is quite shut for these countries.
Tobias, if I could just end with you, are policymakers, including the IMF, doing enough to ensure that emerging markets and frontier markets are protected and can thrive going forward out of this economic crisis?
The IMF is there to help the membership. We have over 190 member countries, and we have received over 100 requests for help. We have already started lending to over 50 countries in order to support economies in this dramatic crisis. Let me also add that the policies of advanced economies have positive spillover effects into emerging markets and low-income countries. So with the easing of financial conditions, market access has been restored for a number of countries.
Thank you both. I think we'll leave it there for today. Covered a lot of ground, but appreciate this wide-ranging discussion.
Very much.